Success in trading is not built in a single trade. It is not built in one good month, and it is definitely not built by chasing the next hot strategy. Real trading success is built quietly, patiently, over time. It is built through consistency, day after day, decision after decision, small actions repeated long enough to compound into something powerful. And there is only one thing that creates that kind of consistency: a trading plan that you actually follow. Today, we are not talking about quick profits. We are not talking about secret indicators. We are talking about how to build a trading plan that sticks, a plan you don't abandon when emotions rise, a plan that supports you not just today, but for years. Because here's the truth most people don't want to hear. Markets don't destroy traders. Lack of structure does. Most people enter trading believing success comes from prediction. They believe if they can just forecast price correctly, if they can just find the perfect entry, if they can just avoid losing trades, everything will fall into place. So they spend months, sometimes years, jumping from strategy to strategy. Indicators, signals, Telegram groups, YouTube videos, always searching, but rarely committing. And that is why most traders never make it. Not because strategies don't work, but because discipline breaks before the strategy has time to prove itself. A professional trader is not someone who wins every trade. A professional trader is someone who executes the same process, the same rules, the same risk framework, again and again, regardless of emotion. And that process starts with a trading plan. A real trading plan is not just a document, it is a decision about who you are as a trader. It defines what you trade, when you trade, why you trade, how much you risk, when you walk away, and how you respond when things don't go your way. Without a plan, every trade becomes emotional. Every loss feels personal. Every win feels fragile. With a plan, trading becomes execution, not gambling. Now, before we build one, we must understand why most trading plans fail, because many people do write plans and still ignore them. The biggest reason? The plan is not honest. Traders often design plans based on who they wish they were, not who they actually are. They write rules like, I'll trade 8 hours a day while working full-time. I'll risk only 1% until impatience shows up. I'll follow rules strictly until fear takes over. A plan that doesn't fit your real lifestyle, your real schedule, and your real psychology will collapse under pressure. A trading plan must be realistic before it can be effective. So, the first step in building a plan that sticks is clarity of purpose. Ask yourself this seriously. Why are you trading? Not what sounds good, not what impresses others, but what is true. Are you trading to build long-term wealth? To supplement income? To eventually replace your job? To grow capital slowly and safely? If your purpose is unclear, your decisions will be chaotic. A trader without a clear purpose reacts emotionally to short-term outcomes. A trader with a clear purpose stays focused on the long game. Your purpose is the anchor that keeps you disciplined when the market tests you. And the market will test you. Once your purpose is clear, the next step is choosing a trading style that fits your life, not your ego. Many traders fail because they choose what looks exciting instead of what is sustainable. Scalping looks fast and thrilling, but destroys impatient traders. Day trading looks flexible, but is impossible with a full-time job. Swing trading looks slow, but rewards discipline and planning. There is no best style. There is only the right style for you. Your trading style should reduce stress, not increase it. It should allow you to follow rules, not tempt you to break them. When your style fits your personality, discipline becomes easier. And when discipline becomes easier, consistency follows. This is where real success begins. Once your purpose is clear and your trading style matches your life, the next step is focus. And this is where many traders sabotage themselves without realizing it. They try to trade everything, every market, every pair, every stock, every new opportunity they hear about. But focus is not a limitation. Focus is leverage. A trader who watches everything understands nothing. A trader who specializes begins to recognize behavior, rhythm, and structure. So your trading plan must clearly define what you trade. Decide the market first. Forex, stocks, crypto, commodities, indexes. Not all of them. One primary market to master. Then define the instruments inside that market. A small, manageable list. Professionals don't chase movement, they study behavior. They learn how specific assets react to news, sessions, volatility, and time. The fewer charts you follow, the deeper your understanding becomes. And deep understanding creates confidence. Confidence reduces hesitation. Reduced hesitation leads to clean execution. Next comes the heart of your plan, your strategy rules. This is where emotion must be removed completely. Your strategy is not a feeling. It is not a guess. It is a checklist. You must define exactly what needs to happen before you enter a trade. What trend conditions must exist? What time frames matter? What pattern, structure, or indicator confirms your idea? If you cannot describe your setup clearly in words, it is not a strategy. It is intuition. And intuition is dangerous when money is on the line. Your plan must also define what disqualifies a trade. When will you not trade? Low volume, high impact news, choppy conditions, poor structure. Rules that say no protect your capital more than rules that say yes. Every trade you avoid impulsively is a win. A good trading plan does not increase how often you trade. It increases how selective you become. And selectivity is power. Now we reach the most important section of any trading plan, risk management. This is where most traders fail permanently. Not slowly, not eventually, permanently. Because they underestimate risk until one mistake erases months or years of effort. Your trading plan must include non-negotiable risk rules. How much of your account will you risk per trade? 1%? 0.5%? Not sometimes, always. How many trades are you allowed per day or week? What is your maximum drawdown before you stop and reassess? These rules are not designed to limit you. They are designed to protect you from your worst impulses. A professional trader thinks in probabilities, not outcomes. They know losing trades are part of the business. The goal is not to avoid losses. The goal is to control their size. Because if losses are controlled, the account survives. And if the account survives, growth is possible. Next, your plan must define how you exit trades. Most traders obsess over entries. Professionals obsess over exits. When will you take profit? At a fixed target? Using structure? With a trailing stop? Your plan must answer this in advance, because exits driven by emotion always lead to regret. Fear makes you exit too early. Greed makes you hold too long. Rules remove that conflict. When profit-taking becomes mechanical, consistency becomes possible. Now we move beyond the chart, into the routine. A trader without a routine is reactive. A trader with a routine is intentional. Your trading plan must include what happens before, during, and after trading. When do you analyze the market? When do you place trades? When do you stop? When do you review your results? Professionals do not trade all day. They trade at specific times with specific preparation and then step away. Structure outside the trade creates discipline inside the trade. Now we enter the part of trading that decides who survives and who disappears, your mind. You can have the best strategy in the world, perfect entries, perfect exits, but without emotional control, none of it matters. This is why your trading plan must include journaling and psychological rules. Let's start with the journal. A trading journal is not just a record of wins and losses, it is a mirror. It shows you who you really are when money's on the line. Every trade you take should be documented. Why you entered, what setup was present, what your risk was, how you felt before, during, and after the trade, and what you learned. Over time, something powerful happens. Patterns emerge. You begin to see where you break rules, when you overtrade, what emotions cost you the most money. And once something is visible, it becomes controllable. Traders who don't journal repeat the same mistakes for years because they never confront them. Your plan must also specify how often you review your journal. Weekly for active traders, monthly for longer-term traders. Reviewing is where growth happens, not during the trade, after it. Now, let's talk about psychological rules. This is the section that saves traders from self-destruction. Your plan must answer questions like, what do you do after 3 losing trades in a row? What do you do after a big winning day? When do you stop trading for the day? Winning streaks are just as dangerous as losing streaks. Wins create overconfidence. Losses create desperation. Both lead to broken rules, so you need predefined responses. Rules like, after a losing streak, I reduce size or stop for the day. After a winning streak, I do not increase risk. If I feel anger, frustration, or urgency, I step away. These rules are not weakness, they are maturity. Professionals don't fight emotions, they manage exposure to them. Your trading plan should also include break rules. When will you not trade? After lack of sleep, during emotional stress, when distracted. Trading while compromised is one of the fastest ways to give money back. Protect your mental state as aggressively as you protect your capital. Now comes something most traders ignore: review and evolution. Markets change. You change. Your plan must evolve, but not impulsively. Your plan should include scheduled review points, weekly reviews to check execution quality, monthly reviews to assess strategy performance, quarterly reviews to make meaningful adjustments. Never change rules during emotional moments. Adjustments must come from data, not frustration. A plan that evolves intentionally stays relevant. A plan that changes emotionally becomes chaos. Now let's address the hardest part of all: sticking to the plan. This is where everything either comes together or falls apart. A plan sticks when it is simple. Complex plans break under pressure. Simple rules are easier to follow when emotions rise. Remove unnecessary indicators. Remove vague language. Make every rule clear and binary. Yes or no, trade or no trade. Another key to sticking to your plan is identity. Stop seeing yourself as someone trying to trade. See yourself as a professional in training. Professionals follow processes. Amateurs chase outcomes. When you shift your identity, behavior follows. You must also understand the difference between motivation and discipline. Motivation is temporary. Discipline is reliable. Motivation disappears when losses come. Discipline remains. Discipline is built by repetition, not inspiration. Every time you follow your plan, you strengthen that muscle, and every time you break it, you weaken it. Now, let's bring everything together, because at this point, you don't just have rules, you have a framework for long-term success. But to truly make your trading plan stick, one final mindset shift is required. You must accept deeply that losses are not the enemy. Trying to avoid losses is what destroys traders. Trying to control them is what saves them. Every professional trader loses, regularly, calmly, without panic. Losses are not a signal that your plan is broken. They are a cost of doing business. Once you accept this, something powerful happens. You stop reacting emotionally, you stop forcing trades, you stop revenge trading, and following your plan becomes natural. Another critical shift is how you define success. Most traders measure success by profit. Professionals measure success by execution. If you followed your plan perfectly and lost money, that is a win. If you broke your rules and made money, that is a loss disguised as success. Reward discipline, not outcomes. This single principle will change your trading forever. Because when discipline becomes the goal, results follow automatically. You must also learn to celebrate progress, not perfection. Trading improvement is slow, silent, often invisible in the short term. But if you improve your execution by just 1% each week, you become unrecognizable over time. Celebrate fewer mistakes. Celebrate controlled risk. Celebrate patience. Confidence is built from consistency, not luck. Now let's recap what a real trading plan includes. It includes your purpose, your why, your trading style, how you operate, your markets, what you focus on, your strategy rules, when you trade, your risk management, how you survive, your entry and exit rules, how you execute, your routine, how you prepare and review, your journal, how you learn, your psychological rules, how you protect yourself, and your review process, how you evolve. And most importantly, it is written down. A plan in your head is a wish. A plan on paper is a commitment. Read it before trading, review it after trading, return to it when emotions rise. Protect your plan like capital, because it is. Now imagine yourself 1 year from today. You know exactly what to trade, exactly when to trade, exactly when to stop. No panic, no impulse, no chaos, just clarity, control, consistency. That future is not built by prediction, it is built by discipline. Trading is not a lottery, it is a craft. Professionals follow structure. Professionals respect risk. Professionals commit to process. The moment you stop reacting to the market and start operating by a plan is the moment you stop gambling and start trading. So take ownership, build your plan, honor it, refine it, live by it. Because your trading plan is not just a document, it is the foundation of the trader you are becoming. And long-term success begins right here.